Hi everyone, I'm Chris Tipper, Chief Economist and Strategist for the Ainslie Group, and welcome to Ainslie Insights for another week, starting with our precious metals update. This week, the precious metals markets continue to demonstrate notable activity and varied responses to changing dynamics. Gold, silver, and platinum each present distinct trends shaped by global economic conditions, geopolitical influences, and the balance of supply and demand. Whether you're a seasoned investor or an individual observing market developments, I'm here today to deliver a thorough analysis informed by the latest reports. This presentation is brought to you by ainslie.com.au, the home of Ainslie Bullion, Ainslie Crypto, Ainslie Wealth, and the Gold and Silver Standard. Be sure to have a look. Let's get started with gold. Gold closed the week holding relatively strongly, maintaining its footing just above the 5,000 Aussie dollar per ounce mark, a testament to its steadfastness amid the fluctuations witnessed throughout 2025. But what sustains this enduring resilience? The foundation lies in falling confidence in global systems. The protracted Russia-Ukraine conflict and ongoing trade disputes between the United States and China persist in unsettling investors. In such circumstances, gold emerges as a dependable refuge. Significantly, central banks, including the People's Bank of China, are amassing gold reserves at an impressive pace, with estimates now approaching 5,000 tonnes. This institutional endorsement underscores gold's sustained allure. Furthermore, prominent hedge funds such as Ray Dalio's Bridgewater Associates are enhancing their allocation to gold ETFs, reflecting a firm conviction in its enduring worth. This institutional backing supports analyst projections. For example, JP Morgan anticipates that gold may attain $6,000 by 2029, which at current exchange rates translates to over 9,000 Aussie. Such forecasts present a persuasive case for investors. Nonetheless, recent market adjustments warrant consideration. A modest reduction in trade tensions between the United States and China, demonstrated by tariff reductions from 145% to 30% on the US side and from 125% to 10% on China's, has moderated immediate safe haven demand. Additionally, new indications from the US Federal Reserve of caution around expectations for prospective rate cuts may affect the opportunity cost of holding gold, particularly should yields increase. However, these still appear to represent short-term shifts within a broader upward trajectory. For Australian investors, with the Aussie dollar at 64 cents, around 5,000 Aussie dollars per ounce at present creates a strategic opportunity to leverage global trends while safeguarding against currency instability. Gold endures not merely as a commodity, but as an emblem of constancy in an uncertain world. Shifting attention to silver, which stands at $50.44 Aussie cents per ounce, it continues to be distinguished by its dual identity, serving both as an industrial commodity and as a precious metal asset. This duality positions silver advantageously in the present market. A pivotal influence is silver's pronounced correlation with copper. With copper stabilising near $4.70 per pound and exhibiting potential for an advance beyond $5, silver may experience a commensurate surge. This stems from the fact that over half of silver's demand derives from industrial applications, notably in solar energy, electric vehicles, and sustainable technologies. The International Monetary Fund projects a 66% rise in copper demand by 2040, and silver is poised to reap the benefits of this trajectory. Economic signals from the United States further bolster silver's prospects. Recent softer data, including a declining producer price index and lackluster retail sales, have weakened the US dollar, thereby enhancing silver's attractiveness. Moreover, the Federal Reserve's thoughts around rate cuts has triggered a short-covering rally in silver. However, geopolitical factors such as the US prohibition on Chinese semiconductor firms introduce ambiguity regarding industrial demand, though this is offset by heightened safe haven interest. From a technical standpoint, silver displays potential indications of an imminent breakout. Analysts are closely monitoring the $33 threshold, a bit over 51 Aussie, as a critical juncture for further upward momentum. Over the long term, many analysts believe that a decline in faith in fiat currencies could markedly elevate silver's value. Potential risks include elevated US yields, which have recently exerted downward pressure on silver, and the possibility that the normalising of trade tensions may diminish safe haven demand. Nevertheless, at just over 50 Aussie dollars, silver is regarded by many as undervalued and primed for appreciation. Lastly, platinum remains steadfast at 1,541 Aussie dollars per ounce, having appreciated by over 10% since the start of the year. This metal's understated strength is increasingly garnering recognition. Supply limitations constitute a fundamental driver of platinum's market dynamics. Johnson Matthey predicts a deficit of 736,000 ounces for 2025, propelled by production difficulties in South Africa, including power deficiencies and ageing infrastructure. Simultaneously, industrial demand is escalating, particularly in petroleum refining and the manufacture of premium glass for electronics. A noteworthy area of expansion is the hydrogen economy, where platinum is integral to fuel cells for hydrogen vehicles. Initiatives such as the European Union's €4.4 billion investment in South Africa's clean energy framework highlight the long-term potential for platinum demand. This situates platinum not only as a precious metal, but also as a vital contributor to the shift towards sustainable energy. In the United States, proposed policy adjustments, including initiatives to enhance domestic mining in Montana and curtail Russian imports, could further constrict global supply, potentially bolstering prices. However, the transition to electric vehicles presents a challenge, diminishing demand for platinum in catalytic converters. This is mitigated by the gradual adoption of hydrogen fuel cell vehicles, which may sustain demand over time. At 1,541 Aussie dollars per ounce, platinum is deemed by many to be undervalued. Projections suggest a year-end target of 1,650 Aussie dollars, and its blend of scarcity and emerging industrial utility continue to render it as an appealing investment. Gold at over 5,000 Aussie dollars, despite short-term pressures, remains a bedrock of stability, reinforced by institutional demand and geopolitical uncertainty. Silver at around $50 offers a compelling prospect, propelled by its industrial significance and potential for value growth. Platinum at just over $1,500 provides a distinctive opportunity, balancing supply constraints with rising demand from the green energy sector. For Australian investors, with the Aussie dollar at 64 cents, these metals afford not only a safeguard against currency fluctuations, but also a direct participation in the current global economic developments. As has been the case for most weeks recently, this week I'll continue to focus on economic indicators, trade developments, and supply updates, as these are the most likely drivers to shape market direction. Precious metals persist as a dependable means of diversification in an unpredictable global landscape. What do you think? Do you regard precious metals as a vital element of your investment approach? Share your insights in the comments below. I'm away next week, but shall return the following Monday with further analysis. Until then, good luck in the markets and be sure to visit ainslie.com.au for the latest news and updates.